So imagine finding a stock that has exploded like over 560% in a single year.
Oh, man. Yeah, your instinct probably just screams that it's entirely overbought, right?
Exactly. I mean, you look at the chart, you see those dizzying parabolic heights, and your brain immediately registers this classic falling trend setup, like it's just waiting to trap the latecomers.
Yeah, you feel like you're staring at this dangerous, unscalable mountain.
Right. And here's the crazy part. What if the data, specifically this staggering forward PE ratio, suggests that it's actually, totally undervalued?
Which is wild.
Yeah.
Because the underlying financial math is basically insisting that you're actually standing in a valley, not at the peak.
Yeah. And before we unpack this wild setup, make sure to like the video, subscribe to our YouTube channel, and, leave your comments and feedback down below. We really want to know where you stand on this debate.
Definitely let us know.
So, our mission in this deep dive today, and we're looking at April 16th, 2026, is to tear into Micron technology, ticker symbol MU.
Oh, yeah. Micron is the one to talk about right now.
It really is. We are going to look past the mainstream hype, break down the raw financials, the technicals, and try to figure out if this is a genuine breakout opportunity or just a giant value crap waiting to snare retail traders.
And just to set the stage for you listening, this is natural analytical debate, right? We're exploring the market dynamics purely for educational purposes.
Exactly. No financial advice here.
Right. Absolutely zero financial advice.
Yeah.
You always have to, run your own research.
So let's just start with the sheer scale of this move because we have to understand this valuation paradox. As of today, April 16th, Micron is trading around $457.23, up like a modest 0.22% on the session.
Which is crazy when you look at the 52-week range.
It is. I mean, just a year ago, the stock was scraping the bottom at $65.65, and it recently hit an all-time high of $471.34.
Yeah, a 560% vertical climb. Normally, that means the valuation is just stretched to the absolute breaking point.
Right, and this is the paradox, the trailing PE sits at a reasonable 21.59, but the forward PE is an astonishingly low 4.91.
Yeah, 4.91 on a hypergrowth tech stock.
Mm.
That almost defies market gravity.
It feels like, I don't know, walking into a dealership, pointing at a brand new luxury sports car, and they quote you the price of a bicycle.
That's actually a great way to put it.
But I mean, when a number looks that good on a stock up 560%, isn't the market usually hiding a catch? Like, is this truly undervalued, or is it the ultimate retail value trap?
Well, I think this is a textbook case of price anchoring, honestly. You have human psychology violently clashing with corporate math.
Because retail traders fear that 560% gain.
Exactly. And even some institutional algorithms lock onto that $65 price tag from last year. They see $457 and their brain just signals danger. They think, the boat has sailed.
Because they're anchoring to the past, not the forward earnings power. And expected earnings are projected to grow by, 600% in 2026?
Right. The market doesn't have a memory. It only cares about future discounting. So a forward PE of 4.91 is just telling us the share price actually hasn't kept up with the business model's growth.
Okay, but if that 4 PE isn't a trap, the actual cash flow and the balance sheet have to absolutely back up the hype.
Oh, 100%. We have to verify what's actually sitting in the bank.
So let's look under the hood.
Yeah.
Q2 fiscal year 2026 income statement. The reality here is historic. Revenue hit $23.86 billion.
Which is a 196% year-over-year increase. That's just massive.
A legacy hardware manufacturer just tripling its revenue in 12 months, and net income was $13.79 billion.
Yeah, they crushed it. Earnings per share totally demolished estimates. Actual EPS was $12.20 versus the $8.60 estimate.
But the thing that really made my jaw drop was the gross margins. They leaped from 22% last year to 67.6% now.
Right, and that astronomical leap to 67.6%, that's the beating heart of the whole Micron bull thesis.
How do you even do that with physical hardware?
Well, it proves the nature of what they sell has fundamentally changed. They aren't just pushing, commoditized memory chips anymore. They have incredible pricing power now.
Which allows them to build this staggering balance sheet. They've got roughly $82.8 billion in total asset.
Yep. And heavily net cash positive.
Right, $16.7 billion in cash and investments against only $10.8 billion in debt. And working capital is sitting at $17.39 billion.
Which is incredibly healthy. They generated $6.9 billion in adjusted free cash flow just in this quarter alone.
Okay, and this is where I start getting a little nervous, they are pouring $5.8 billion of that straight into CapEx for manufacturing.
The factory buildouts.
Yeah. $5 billion just on manufacturing infrastructure. I mean, if demand slips even a fraction, doesn't that massive investment become a giant, expensive anchor pulling them down?
It's a fair question because that's the classic boom and bust cycle that usually plagues legacy chip makers, right?
Right.
The market always anticipates the bust.
Exactly. They overbuild during the euphoria.
Right, but you have to contextualize this specific spending. This isn't a luxury, it's a necessity. They are building out capacity for HBM4 high bandwidth memory.
Which is notoriously hard to make, from what I understand.
Exactly. It requires extreme precision. And that leap in gross margins to nearly 68%, that proves their current pricing power can easily fund this expansion safely without taking on toxic debt.
Okay, so if the financials are that pristine, we really need to follow the money and look at what the smart money is actually doing with their shares.
Oh, absolutely. The institutional versus insider activity right now is fascinating.
Right. So on the institutional side, we're seeing heavy accumulation.
Yeah, giant asset managers are just swallowing up shares.
Because Micron's capacity for HBM4 is completely sold out, right?
Completely, contractually locked in. The institutions are positioning for a multi-year trend here.
But then you look at the insiders, and there is some notable profit-taking happening. Specifically, Executive VP Michael Cordano sold 3,407 shares for roughly $1.48 million on April 14th, 2026.
Right, taking some chips off the table.
Yeah, and look, on a human level, I get it. If you built a house and its value went up 500%, you'd probably sell a spare bedroom to buy a boat, right?
Oh, for sure.
That doesn't mean you hate the house. But still, if the HBM4 capacity is fully sold out and the future is so bright, why is an executive VP taking almost $1.5 million off the table right before the next earnings?
Well, you have to separate institutional positioning from an executive's risk management. Institutions are buying an infrastructure layer for their massive, diverse portfolios.
Right, they have a million other assets.
Exactly. But an executive VP often has most of their net worth tied to this one single ticker. So when it goes up 560%, selling $1.5 million is just scheduled, logical risk management. It's usually done through blind 10b5-1 plans anyway.
So it's not a panic signal.
Okay.
But while the fundamentals in institutions look long-term, technical analysis tells us what the stock is going to do tomorrow.
And where the retail traps lie.
Exactly. So let's look at short-term weakness versus strength. The trend direction is just powerfully bullish.
Oh, yeah. Trading well above the key moving averages.
Right, the 50-day is way down at $428.65, and the 200-day is at $404.09. So we're seeing strong buy signals across the 5, 50, and 200-day timeframes.
The momentum is undeniable.
But we've got to talk about support and resistance. There's immediate support at $444.
Heavy institutional buy walls there.
But then, right above the current price, there's this heavy sell-side resistance clustered between $462 and $465.
Yep, with the ultimate all-time high resistance looming at $471.34.
And the momentum indicators are kind of sending mixed signals, aren't they? I mean, the MACD is at 8.55, which is super bullish.
It is. It shows the velocity of the buying is outpacing the historical average.
But then the short-term outlook on the RSI, the Relative Strength Index, it's at 63.09.
Right, which is strong, but definitely approaching overbought territory.
And the stock is stuck in this short-term consolidation phase, just constantly testing that $460 resistance. And this is exactly where I see retail traders get trapped.
Oh, all the time.
Yeah, because everyone sees approaching overbought on the RSI, and they just panic and sell. Or worse, they succumb to FOMO, they buy exactly at the $465 resistance, and just get chopped up when it rejects.
That's a classic grinder.
So how does a trader actually survive this specific consolidation zone without getting shaken out?
Well, you have to understand the mechanics of order flow. People misinterpret consolidation near all-time highs. They see it stalling and think it's weakness.
Right, they think the rally is dead.
But it's actually a sign of immense strength. Think about that heavy support at $444. Every time it dips, massive buyers are absorbing the supply.
Okay, so it's digesting the massive gains.
Exactly. After a 560% run, early investors take profits. Normally that tanks the stock. But here, the market is absorbing all that selling pressure right near the highs. It's coiling like a spring.
Okay, so with the stock coiled that tight, we need to lay out the catalysts. What is going to trigger the ultimate best-case breakout or the worst-case continuation lower?
Let's start with the signals. Analyst consensus right now is overwhelmingly a strong buy.
Yeah, like 25 plus analysts, right?
Yep, with an average target of $533.72.
Wow. And the next earnings are coming up fast on June 24th, 2026.
Right, with guidance expected to rise to around $33.5 billion.
Okay, so the best case scenario is a breakout that targets $500 plus.
Easily. And the long-term driver for that is their monopoly-like position. They are the primary supplier of HBM4 for Nvidia's next-gen Vera Rubin AI chips.
That's a massive catalyst. Plus, didn't they just announce a 30% dividend hike?
They did, which
Wow.
is a huge signal of confidence. Right now, sentiment is entirely driven by this AI physical bottleneck narrative.
Basically, the physical hardware just can't keep up with the AI dreams.
Exactly. But we have to talk about the bear case, the worst case scenario, and the downside risks.
Yeah, because sentiment is currently registering as extremely greedy, making it highly volatile.
Highly volatile, and you've got macro risks looming, like inflation, geopolitical tensions in Asia.
And this is the one that really gets me there, is a major looming tech risk.
Right.
Google's new algorithm. TurboQuant.
Yes, this is the existential threat.
I mean, I look at TurboQuant and I think everyone is playing checkers, focusing on the hardware bottleneck for AI, but Google is out here playing chess.
They're trying to write code that just needs less hardware.
Exactly. Could TurboQuant be the pin that pricks this 600% growth bubble?
It's the ultimate debate of physical hardware versus software efficiency. TurboQuant relies on quantization, basically rounding down the complex math AI uses so it takes up way less memory space.
So they wouldn't need all that fully sold out HBM4 capacity.
Right. If software eliminates the hardware bottleneck, that massive $5 billion factory expansion suddenly looks like a huge misallocation of capital. It makes the stock fundamentally high risk despite those glowing financials.
Wow. Okay, so we're looking at a true collision here. On one hand, we have a company printing cash with 67% margins and a completely sold-out product, resting at this technical crossroads where it could easily blast past a $500 breakout.
But on the other hand, you're facing a potential software-driven reality check that could reset the entire industry's demand curve.
It is a mesmerizing standoff. And just a quick reminder for you listening, this debate explored multiple perspectives of the market and should absolutely not be taken as financial advice.
No financial advice, always do your own due diligence.
But I do want to leave you with a final thought to ponder. Right now, the market is pricing in the belief that AI's physical hardware limitations will last forever.
But if history tells us anything, software always evolves to overcome hardware limits.
Exactly. So the real question you have to ask yourself isn't whether Micron is valuable today, but whether the AI of tomorrow will even need them.
It's a huge question.
So jump into the YouTube comments, let us know your verdict on the stock, and we will see you next time.